Wall Street just quietly moved 1 trillion onto the blockchain, and most crypto investors have no idea what's about to happen to their portfolios. This isn't hype. This isn't speculation. The numbers are already there. The institutions are already moving. And the retail investors who understand what's happening right now are going to look like geniuses in 2 years. The ones who ignore it are going to wonder why they missed another massive shift. So let's talk about what's actually going on. Because this trend doesn't get the attention it deserves. It doesn't have a flashy ticker symbol. It doesn't go viral on crypto Twitter. But it might be the most important thing happening in finance right now. It's called real-world asset tokenization, and it's changing everything. Here's the simple version. For centuries, certain assets have been locked behind walls. You want to invest in a commercial real estate building in Manhattan? You need millions of dollars in the right connections. You want access to private credit deals that generate steady returns for hedge funds? Sorry, that's not for you. You want a piece of a U.S. Treasury bond portfolio managed by one of the biggest financial institutions in the world? You need to meet a minimum investment threshold that most people will never reach in their lifetime. That's how traditional finance has always worked. Big players get access to the best assets. Everyone else gets the leftovers. Tokenization breaks that wall. When you tokenize a real-world asset, you're essentially taking something valuable, a building, a bond, a loan portfolio, and representing ownership of it on a blockchain. You divide it into digital tokens. Those tokens can be bought, sold, and transferred just like any other crypto asset. But instead of speculative value, they're backed by something real, something that generates income, something with tangible worth in the physical world. And right now, the biggest financial institutions on the planet are doing exactly this, at scale. BlackRock launched a tokenized treasury fund on Ethereum. It passed $500 million in assets in record time. Franklin Templeton has a tokenized money market fund live on multiple blockchains. JP Morgan has been processing billions in tokenized repo transactions. Goldman Sachs, Fidelity, HSBC, they're all in. This isn't pilot programs anymore. This is real capital moving through blockchain rails. The total market for tokenized real-world assets crossed 1 trillion in 2025. And analysts are projecting it could hit 10 trillion by the end of the decade. Some projections go even higher. We're talking about a 10 to 30 times growth window, and we're still in the early innings. So why is this happening now? Why not 5 years ago? A few things came together at the same time. Blockchain infrastructure got better, transaction speeds improved, costs dropped, regulatory clarity started to emerge in key markets. Institutions that spent years studying this technology finally had the tools and the legal framework to move forward. The crypto winter of 2022 and 2023 actually helped in a strange way. It cleared out a lot of the noise and speculation, and it forced builders to focus on things with real utility. Tokenization has real utility. Undeniable, obvious, practical utility. Think about real estate. Global real estate is worth over 300 trillion. It's the largest asset class in the world, but it's also one of the most illiquid. You can't sell 2% of a building when you need cash. You can't buy 500 worth of a commercial property in Singapore from your phone. Tokenization makes that possible. Fractional ownership of real estate becomes as easy as buying a stock. And suddenly, assets that were locked up for decades become liquid, tradable, and accessible. Same with private credit. This is a $1.7 trillion market that most people have never even heard of. It's basically loans made to companies outside the traditional banking system. The returns can be really attractive, often 8%, 10%, 12% annually. But historically, only institutional investors and ultra-high net worth individuals could access it. Tokenization opens that door, and several platforms are already letting retail investors participate in tokenized private credit with much lower minimums than before. Now here's where it gets really interesting for crypto investors specifically. When you tokenize assets on a blockchain, you need infrastructure. You need smart contract platforms. You need Oracle networks that feed real-world data onto the chain. You need compliance layers, custody solutions, interoperability protocols. You need a whole ecosystem of services to make this work. That ecosystem is being built right now, and the tokens that power it are sitting in front of you. Ethereum remains the dominant platform for institutional tokenization. BlackRock chose it for a reason: network effects, developer ecosystem, security. But other chains are competing aggressively. Polygon has major enterprise partnerships. Avalanche has the Evergreen subnet specifically designed for institutional use cases. Stellar has been quietly processing cross-border tokenized asset settlements for years. Chainlink, the Oracle network, is deeply embedded in almost every major institutional tokenization project because real-world assets need real-world data, and Chainlink provides that bridge. This is not investment advice. Do your own research. But understanding which infrastructure is being used by the institutions that are driving this $1 trillion trend, that's just good information to have. There's something else worth understanding here. The speed of this shift is going to surprise people. We tend to overestimate how quickly technology changes things in the short term, but we massively underestimate the long-term impact. Tokenization felt like a distant future concept in 2020. In 2022, it felt like something institutions were dabbling with. In 24, serious capital started flowing. Now we're at 1 trillion and accelerating. In 5 years, asking whether a financial asset should be tokenized might feel as strange as asking whether a document should be stored digitally. It'll just be the default. The investors who position themselves now, who understand the mechanics, who know which assets are being tokenized, who understand the infrastructure behind it, they're going to have a significant advantage. But there are risks, and you need to know them. Regulatory risk is real. Different countries are moving at different speeds. A regulatory crackdown in a major market could slow institutional adoption in specific jurisdictions. Smart contract risk exists. Code can have vulnerabilities. Liquidity in tokenized markets is still developing, which means some of these assets can't be sold as quickly as you might want. And there's counterparty risk. When you hold a token representing a real-world asset, you're trusting the entity that issued it to actually hold the underlying asset. Transparency and auditing matter enormously here. This space is growing fast, but it's not without friction. Eyes open. What you're watching right now is the collision of two worlds that were always supposed to stay separate: traditional finance and decentralized blockchain technology. Wall Street and crypto, and instead of one destroying the other, they're merging. The institutions are adopting the rails. The blockchain networks are becoming the settlement layer for real global capital. $1 trillion was just the beginning. The next wave is coming, and it will bring more capital, more assets, and more opportunity than anything we've seen in this space before. The question isn't whether this is real. The numbers already answered that. The question is whether you're going to understand it well enough to act on it before it becomes mainstream knowledge. If this opened your eyes to something you hadn't considered before, do me a favor. Hit the subscribe button. This channel covers the trends that matter before they make headlines. Drop a comment below and tell me which part of the tokenization story surprised you most. And if you found this valuable, share it with someone who needs to hear it. The people who understand this early are going to thank themselves later.